In my opinion, it's too early to give any indication what is coming next. What I see is that we are close to our target. So the latest number from September is 2.2%. So it's close to our 2% target. I do not see any reason changing anything if there is not something new coming, and I do not see where it might come from.
That 2.2% that you cite on inflation was still the first time we've seen above 2% since April. And if you look at the services side, also still above 3%. Is there an inflation problem still for the ECB to tackle?
I think you said it rightly. I think the service inflation is still pretty high, so it seems to be very sticky. So, and this is giving me an indication that we shouldn't be complacent, so we have to keep our vigilant stance. And again, we did it right by cutting 8 times. We hiked 10 times before. Now we are close to our target. We have our next meeting by the end of this month. So the information that I see, at least for the moment, giving me not enough arguments changing anything. The course of the monetary policy that we found is the right one, this meeting-to-meeting approach.
How disruptive could tariffs still be from here? Namely, the US and China are still at loggerheads on getting to a trade position, because many of us had discussed the potential for tariffs in Europe to bring lower prices. First up, the goods coming through into Europe, but also in terms of any demand destruction. So do you see tariffs having any impact?
I think over the last 10 months, we were confronted with so many uncertainties. And the tariff discussion and the decisions around tariffs, this is one of these uncertainties. So at the end, I believe this whole situation is not helpful to the economy and how we try to evaluate what is of importance, especially when it comes to monetary policy. And yes, this is producing a lot of, let me say, it's producing a lot of uncertainty. So the whole tariff discussion between China and the United States, what was the, and again, coming back to the discussion we had around the tariffs discussion between Europe and maybe also here the United States, I do not see where are the winners for all this. It looks like to me that it's a lose-lose situation for really everyone.
One potentially destabilising force is coming from within Europe, and that is France. The political situation, we've watched there very closely. How concerned are you about France?
Well, I will not comment on the situation in France explicitly. I think France knows that there is maybe something they really have to solve. I think they have to find an agreement regarding the budget. What I see so far, that the markets are coming to a point where France is being more or less classified in a way that I believe it is appropriate, but I'm pretty convinced that they find a solution in France.
Let me lob a technical question at you though, and this isn't a very ECB specific question, because some believe that France does not meet the ECB's criteria for the use of the TPI, the Transmission Protection Instrument, saying effectively that if you look at the fiscal fundamentals in France, they are too weak. Is that true? Would the TPI be useless if bond vigilantes swept in on French sovereign debt?
What I believe here, that I see a lot of, let me say, misunderstanding when it comes to the TPI. The TPI is a monetary policy instrument. When we think in the Governing Council that we see a case that our monetary transmission is harmed in a certain way. It's not about maybe the fiscal situation of one or the other country. It's about monetary policy transmission and not about maybe helping one or maybe the other country.
So it would be effective if called on?
So I will not speculate about this. I will not speculate about the situation in France. TPI is about monetary policy and nothing else.
And let me ask you about Germany, because we saw the economy ministry lifting growth forecasts last week, 0.2% for 2025, encouraged by government spending, offsetting some of those trade tariffs that have been chipping away at the industrial side of the economy. How resilient do you think the German economy is as we close out 2025 and look forward to next year?
Good news here is that the situation in Germany is improving. So a couple of months ago, I said, well, I see more stagnation for this year. Now we see maybe economic growth by the end of this year. And so we will take up some speed for 2025. IMF is saying 0.9%. Maybe this is good news for Germany comparing the previous numbers. And then for 2027, there's even more growth coming. What I see here is that the German economy, with the help of this large infrastructure program, is taking advantage of the whole situation, and this is good news. So we adapt to the situation that Germany is doing better.
There are huge promises in this 500 billion euro plan approved back in March to revitalise infrastructure and bolster defence. This has been baked into a lot of forecasts from the marketplace, from the German economy ministry as well. But are there obstacles to achieving breakout growth rates of 1.3% next year, 1.4% by 2027? Do you see obstacles in the way?
Well, what I see is that the German government is very committed to do what is necessary to do the right investments, for example, in infrastructure, the digitalization of the economy, then this large defense package on top of it. So what I see, and this is important for financial markets, how committed the German government is. And I believe this is delivering a very strong message to financial market participants. German is there, German will be there in the future, and German will become even more, I believe, much more competitive.
We like the positivity, but there is still some negativity in the marketplace about what's being achieved here. ING, for instance, was saying there's too much hype around German fiscal stimulus, saying creative accounting, effectively shuffling funds from regular public investment into the budget to support infrastructure and this infrastructure fund. But long-term growth potential has not been altered in any fundamental way. What do you say to that?
I think I have a different opinion here. I believe there is now enough stimulus coming from this fiscal package that Germany will change. I think this lesson is learned now in Germany. Politics changed. So, as always, when there is something new, there are some, let me say, people that are a little bit more critical than maybe others. So I believe that the policy is definitely going into the right direction, so Germany will become more competitive.
Another critic, Teneo, is also saying, look, when you weigh up the stimulus, there's a huge focus on fiscal stimulus, but underneath the surface, where is the genuine reform? Do you think Germany is failing to take some of the structural challenges in hand and tackle those reforms?
I think there are a lot of behind that. There are a lot of social reforms behind it. So I think those people have to read what the government already decided on. Germany is changing. There are structural reforms ongoing. And I do not see where I could get to a point that those things that were already being decided are not going into the right direction. So I'm positive here. So it will take time, this is for sure. So the success will not come overnight, but over the course of next year, and then in 2027 we see the positive results.
One reform being touted by the German Chancellor Friedrich Merz is tackling deregulation for European banks, effectively arguing that since the financial crisis there's been too much regulation imposed on European banks, leaving them less competitive versus US peers. Would deregulation be welcome in Europe for the banks? I
think it did not say deregulation in a way, it's more simplification or modernization. Simplification means in this context maybe less bureaucracy, less reporting obligations, but not deregulation. So deregulation is not what the Chancellor really meant. So deregulation means less capital requirements. This is not what he said. It's about reducing, let me say, what I already alluded to, the way we ask banks how many things they do have to report, what do they have to give us as additional information. And in this area we can do a lot to give the banks some relief, but not deregulation.
One of the biggest challenges some of the banks are facing is attempts to consolidate. We've seen it in Germany, we've seen it in Italy and in Spain. The local opposition from governments about those consolidation attempts, despite the European Commission sending warning shots to allow this consolidation to happen. What is your perception of some of the domestic obstacles to creating much larger institutions in Europe?
I think at the end we need more Europe and not less Europe. That does mean to me we need a capital market union, or you can say the savings and investment union, but also a banking union. And so we have to overcome these national obstacles. And I believe this lesson is also something we should draw out of the last 12 months. So Europe is the question, or is maybe the answer, and more Europe and not less Europe. And so the banking union initiative, we should work on that. And this is the clear message that I'm delivering over the last couple of 12 months.
Does it seem extraordinary to you that there is domestic opposition to consolidation of German banks?
Well, I guess it is, as always, when it comes to national interests, you find this kind of, let me say, criticism, obstacles. But as I said, I think in a situation where we are confronted with this level of uncertainties, we have to work on maybe the setup that we can provide to financial market participants, and again, more Europe and not less Europe.
Let me ask you about financial stability. Some of the warnings from the IMF this week has been about the growth of non-bank lenders and the lack of supervision of these particular players, from hedge funds to private credit and beyond, given the build-up of assets that they hold internationally. The other big concern, of course, the run-up in stock market valuations around AI. Are you concerned that we could have a bumpy road from here?
I think I'm concerned when it comes to private credit, private lending. I think this market is really big now. As far as I know, it's more than $1 trillion, and we know there are some spillovers from the less regulated market participants to the more regulated market participants. And we, as regulators, we have to have how can I put it? We have to have a close look at it.
Is the situation too big for the ECB to monitor?
I think it's not too big. I think what we really need, we have to close this data gap, and we work on that, but it's not too big for the ECB. I think we can handle this, but it's a regulatory task.
Just finally, AI is such a huge momentum story. How do you see it impacting productivity in Europe? Are there early examples of what the economic impact could be?
So, as we all know, there are different opinions when it comes to AI and what does that mean to productivity. I'm in the camp of those who believe that AI is a disruptive technology, and I believe also it will come with productivity gains, but it will not come overnight, but it will come. We will see that we see over time when AI is used much more by companies, by more or less everyone, that we will see these productivity gains. The question that I have and the concern that I see, what does that mean to labor markets? I think this is, again, one of these open questions. At the moment, I would say it is too early to say what is the impact that is coming from AI, but it is a disruptive, it will be, already is a disruptive technology.